Okay, so the record is on. I am going to share my screen now. Okay, wonderful. So hopefully you should all be able to see the PowerPoint presentation. Is that true?
Yeah.
Great, wonderful, awesome. Thank you so much for letting me know. Let me go ahead and minimize that. Great. Okay, so I am going to go through, just like we normally would in class, I'm going to go through the PowerPoint presentation. We'll do some example work. And as you have questions, just feel free to stop me, unmute yourself, and ask your question. Okay. I am also going to visualize my, there we go, chat feature as well, so that way we can see what's going on. Great. Okay, so let's rock and roll. So again, the session is being recorded. So for those of you who miss something and you want to rewatch it, you can do so. I'll share the recording after the class has started. Also, a quick note about participation. So because we are in this new learning environment online, what I've decided to do instead of taking attendance and doing it that way, and instead of participation points being awarded through attendance, the way it'll work now is instead of those discussion forums being optional, they're now required. And so what that means is that for discussions for chapter 22 onward, those discussion boards are now required, and so they're no longer optional. Okay. The reason for this change is because I'm not requiring you all to be in attendance virtually at every session. Okay.
Really, I'll be quiet.
I'm sorry, what was that? Did you say?
I'm talking to my niece. Sorry.
Oh, that's all right. No worries. If you don't mind just muting yourself when you're not asking a question, that'd be great. Thank you so much. Okay, so the discussion forums for chapter 22 through chapters 27 are now required instead of being optional. Does everyone understand that?
Mm-hmm.
Great. So if you all could participate in those discussion forums by making an original post, and it would also be great if you could respond to some of your classmates. So if you could, what's that? Okay, so if you can participate in the discussion forums by responding to two of your classmates and making an original response to the discussion question, that'd be fantastic. It doesn't have to be anything long. You know, a paragraph will be sufficient for your response to the discussion question, and then maybe like a sentence or two in response to two of your classmates would also be great for the discussion forums. So again, that's discussions chapters 22 through chapter 27 are now required. They're no longer optional. And that'll take place of a grade for your attendance in the virtual sessions. So, okay, so that's my one housekeeping announcement. So let's jump into chapter 22. So before the break, you had your wonderful, amazing, so great. You had your midterm exam. The midterm exam covered chapters 19, 20, and 21, if I'm not mistaken. And so in chapter 21, we went through the concepts of budgeting. And so in chapter 22, it's a little bit more in budgeting, but we're looking at budgeting from a cost perspective. And so that's what chapter 22 is really about. So let's go ahead and explore chapter 22. And let me enlarge my size here. Okay, great. So here we go. So chapter 22. The first thing I want to talk about are standards. So we, in a general sense in management, we all have a set of standards. And so standards are a set of performance goals. So for example, a performance goal might be I want to sell 5,000 units every week. And so that would be my standard. That's my expectation, my performance goal. That's every week I want to be able to sell 5,000 units. So I would set 5,000 units every week for sales as my standard. In manufacturing, so because we're selling inventory that we're making, we would also need to set what we call standard costs. So if my expectation is to sell 5,000 units a week, I need to, of course, be able to make 5,000 units a week to be able to sell. And so I would set standard costs for direct materials, direct labor, and factory overhead. And those to make my 5,000 units that I need to sell every week, my standard cost would be the cost of direct materials, direct labor, and factory overhead to make those 5,000 units every week. Does that make sense? Yes. Okay, great.
Yes.
Wonderful. Thank you so much. Okay, so let's keep rolling on standards. So in order to track our standards, we have what's called a standard cost system that helps us to set standards for the product costs. And so in this, I'm looking at how much the product should cost and how much does it actually cost. So if my standard is to create and sell 5,000 units per week, I should have an expectation or an estimate, which would be my standard cost, of how much direct materials, direct labor, and factory overhead should go into each unit, okay? And then there's what it actually costs. So just like we did in budgeting, we compared our estimates to our actual performance. The same concept applies in costing. And for cost, our estimate would be the standard cost, and the actual would be the actual cost. Now, of course, over time, we expect things like direct materials, direct labor, and factory overhead to change periodically. You know, the hourly rate won't always be the same. It'll go up or it'll go down. And the same concept applies with direct materials. Those will go up and they'll go down. So we have a standard, what we expect them to be, and we have the actual, what they actually are. So when costs are compared with standard cost, when the actual costs are compared with the standard cost, the difference is reported as a variance. So think of the word variance as being the difference between the actual cost and the standard cost. So that difference is, we call that a variance. And so we have reports that are generated that tell us these variances between the standard cost and the actual cost. And we'll get into that in later slides. So let's talk about how we set standards. So as I said earlier, the standards that we set are the expectations or the goals for our direct materials, direct labor, and factory overhead. So to set these, typically what a manager would do of like a factory or any type of other organization to set goals is we would sit down with department managers and we would ask each one what their expectations are for setting the goals. So it requires it's a joint effort between accountants, engineers, and other management personnel to be able to set these standards or to set these goals. So the accountant would convert the results of judgments, processes, studies, and dollars and cents. So in other words, the engineers and the other management personnel would tell the accounting people what the goal should be, the standard should be. And then as the time goes on, the accountants will look at the difference between the actual cost and the standard cost, which again is what we call a variance. And so the accountants are responsible for calculating that variance. Engineers would, of course, help to identify the materials, labor, and machine hours and things like that needed to produce the product. And so we'll jump into a couple of examples to show you what that looks like. Okay, so still talking about standards, we have what's called ideal standards, okay? They're theoretical in nature. They're kind of like perfect world scenario. You know, if I can make 10,000 units a week and sell 10,000 units a week, that's like the perfect world situation, right? But the reality is ideal standards, they're not really achievable, right? They're ideal, they're theoretical. They're like perfect world, I should be able to make and sell 10,000 units, okay? And so we call these ideal standards. They're what we can achieve under perfect operating conditions. Like the machines are never broken down, they're constantly going, and there's no like material spoilage, meaning like I have bad parts, right? And so these ideal standards help me to kind of create a benchmark, but at the same time, employees view ideal standards as being unrealistic because oftentimes we really can't meet these ideal standards. We're always going to be over or under our costs at any given time, right? And so that's why we call them ideal. They're just kind of, you know, what we hope them to be in an ideal, in a perfect world situation. But the employees don't see this as being positive by having ideal standards because we really can't always achieve them. So like for some of you who work in HR, it's kind of like the concept of employees constantly hitting their goals. It's like we know that that's not always going to happen. And so the goals are really the ideal standards, but at the same time, we know that our employees won't always be able to hit those goals. So the same concept applies in HR. So instead of having the ideal standards, we have what's called currently attainable standards. We oftentimes, I don't know why it says sometimes, it's really often. We oftentimes call these normal standards. These are standards that can be attained with a reasonable effort. So like if my goal is to make 10,000 units and sell 10,000 units every week, I should be able to do that with ease, meaning I'll probably produce, you know, more than 10,000 units. I'll probably make 12,000 units or 14,000 units and still be able to sell those 10,000 units easily, you know, and so we call those normal standards or currently attainable standards. And so we use these as our normal production efforts, right? And this allows for some flexibility, which is really nice. So like going back to chapter 21, if you wanted to kind of relate this, you can think of this as being your flexible budget. It's the same type of concept applies. Okay, and so on a regular basis, we as managers, we need to look at our standards and continually review and update them as time goes on, because we know that the concept of selling 10,000 units every week and making 10,000 units every week, we expect that to change periodically because there will be changes in customer demand, there will be changes in labor rates, there will be changes in pricing, things like that. So we also need to adjust based on those standards based on these changes. And of course, we need to continually critique our standard costs because, again, oftentimes there's going to be changes. So sometimes we will criticize our standard costs for performance evaluation by setting limits to improve our operations. But unfortunately, sometimes these will discourage improvements beyond the standard. So if I set my standards that are always attainable, the thing is, they will limit our employees from being innovative and wanting to improve on those standards. So they'll just keep hitting their goals, but they won't really want to improve beyond that. So that sometimes that could be a negative impact from setting standards. Also, sometimes standards are too difficult to maintain in a dynamic manufacturing environment. So just like what we talked about, I might make those 10,000 units and the customers love them and they keep buying 10,000 units a week. But at the same time, eventually my product might become out of favor, or the environment will change. And so they no longer want those 10,000 units. And so then I have to adjust my standards. But sometimes it's difficult to make those adjustments, especially as things continually change, right? So standards can cause employees to lose sight of the larger objective of the organization. And so, like, if my objective is to continually sell my 10,000 units every week, and they're doing that, eventually we lose sight of what the overall objective of the company is. And so that can be seen as a negative. Standards can cause employees to unduly focus on their own operations, and this could potentially harm the operations that rely on them. So now that we talked about standards, let's talk about budgetary performance. So very similar to what we talked about in the previous chapter, we have our budgets and we have our actual, right? The same concept applies in costing. So the budgetary performance evaluation compares the actual performance against the budget, just like we talked about in chapter 21. So here's an example, and I really like this example, by the way, but I'm not a huge fan of the name. So instead of calling it Western Rider, let's call them Levi, okay? So they manufacture blue jeans, and they use standard costs in their budgets. The standard costs for direct materials, direct labor, and factory overhead are often separated into the following two components. We have standard price and standard quantity. Again, remember, standard means the goal or what we expect it to be, right? So we have standard price and standard quantity for manufacturing our blue jeans. The standard cost per unit for direct materials, direct labor, and factory overhead is computed by taking our standard price and multiplying that by our standard quantity. So again, the standard cost per unit, we take our standard price and multiply that by our standard quantity. Any questions so far? No? Okay.
No.
Great. Thank you. Okay. So looking at our example, the company is manufacturing, in this case, we're looking at an extra large pair of blue jeans. And so we have our direct materials, which is the fabric to make the jeans, okay? The cost of the fabric is $5 per square yard of blue jean material, okay? So a square yard, some of you are probably young enough to remember a yardstick. Once in a while, we would get whacked by our parents with a yardstick if we were misbehaving. And the yardstick is like, it's right. I'm sure some of you have experienced this. I know that
I want you to be go get that switch off the tree.
Exactly. Yes. That's right. Exactly. Yeah. I've been there. I've experienced it. So the yardstick, think of it like it's like a ruler, like a standard ruler, but it's a little bit longer, right? It's a yard, like a football yard. Yes.
You went out, so I missed some of it. So your voice went out.
Oh, okay. Would you like me to start from the beginning of the example?
No, yes, back at the jean example.
Got it. Yep. So this slide is also for the jeans, but going back to the earlier example, to calculate our standard cost per unit, we take our standard price and we multiply that by our standard quantity. Okay. And so this company makes a pair of blue jeans. And so we're going to use this formula through an example. And so we use standard price and standard quantity for direct materials, direct labor, and factory overhead. This company is making an extra large pair of blue jeans. And so the company uses the blue jean material as our direct material, so we purchase that from our supplier at $5 per square yard. A square yard is the distance of 1 yard, which is, you could see that as in a football field as being 1 yard. There's also a very long ruler that we used to get hit with as children called a yardstick. And so that's how a yard is measured. So to make 1 pair of extra large blue jeans, I need 1.5 yards or 1.5 yards. And so if I purchase each yard at $5 and I need 1.5 yards to make a pair of blue jeans at an extra large size, it's going to cost me $7.50 for the materials. And how I got there is I took my $5 and I per square yard, and I multiplied that by 1.5 yards to get $7.50 for the materials. Everyone understands this?
Yes.
Great. And so the same concept applies with labor. So to make a extra large pair of blue jeans, it takes 0.8 hours to make 1 pair of blue jeans. So that's slightly less than a full hour. And so if I pay my seamstress or my the person that makes the blue jeans $9 per hour, if it takes them 0.8 hours per pair, that would be $7.20 per pair of blue jeans for labor. And I got that by multiplying my $9 per hour times 0.8 per pair of blue jeans to get my $7.20 labor cost per pair of blue jeans. Does that make sense? Yes, great. Okay, and now on the factory overhead. Now, of course, we talked about our labor, our materials, which is the actual jean material, our labor, which are the employees that run the sewing machines and are doing the hemming and all that good stuff. And then we have our factory overhead. The factory overhead, as you probably would think, is the cost of running the machine, the sewing machine, right? And so it costs me per hour to run a sewing machine $6. It uses $6 per hour of electric. And so, and that also might include some maintenance, right? So if it costs me $6 per hour to run the sewing machine, it will take me 0.8 hours of machine use to make a pair of blue jeans. So if I multiply my $6 per hour of operating the machine times my 0.8 per pair of blue jeans it takes to make on a sewing machine, that gives me $4.80 for factory overhead. Now, what I need to do from this point is I add my direct materials cost per pair of blue jeans of $7.50 plus $7.20 of direct materials per pair of blue jeans plus $4.80 to run the sewing machine to make the pair of blue jeans gives me $19.50 total cost per pair of blue jeans. Does that make sense? Hopefully, yes.
So it's $19.50 to make 1 pair of blue jeans.
That's correct.
Okay.
That's correct. Absolutely right. That's probably why you're like going to the mall and you're like, how is this pair of blue jeans like $75, right?
That was about to be my question, Professor B. So those are those jeans that are the expensive end jeans. So these are the $20 jeans that they sell for $100.
I know that, right? And so remember going back to our Macy's example that we talked about in class, the red shirt. You guys remember that example I gave?
Yeah. Regardless of the shirt, that when it's on sale,
they're still making a hell of a profit.
Yeah, they're still making money regardless.
Exactly. Yep. So the same concept applies here. So this my assumption is that this is in the United States because of the higher cost of labor, and all that. So that's why, like, you would see Levi's that are made in the United States. You see that the cost of a Levi pair of blue jeans is much higher than other pairs because they're made in the United States. And this is why. This is the exact reason why. Okay, and so let's look at this from a larger perspective, and I'll give you a larger perspective from a budget and from the cost perspective in the next few slides. So looking at this from the budgets, we talked about in chapter 21, we talked about a master budget. And how we got a master budget again is we approached the different departments and they all told us what their budgets were for their department. And we bring that all together into one master budget for the company. And so the master budget is prepared based on the planned sales and production from this perspective. The budget costs for material purchases, direct labor, and factory overhead are determined by multiplying their standard cost per unit times the planned level of production. So if I plan on making 5,000 pairs of blue jeans, I'm going to take my $19.50 from this example, and I'm going to multiply that by the 5,000 pairs of blue jeans I plan to make to give me my budgeted cost, right? Everyone understands that concept? Yes, great. Okay, so the budgeted costs or the standard costs are then compared to the actual cost during the year. So just as we talked about in my example when I was working in the hotel business, I would always compare every single month the budget to the actual performance. We do the same thing in manufacturing, and I'll show you that in an example here in a little bit. So let's talk about that difference, the difference between the budget and the actual, or the standard cost in comparison to the actual cost. The difference between those, we call those cost variance. Anytime you see the word variance, it means the difference between the standard cost and the actual cost. We call those variance costs, or cost variance. And so we have both favorable variance and unfavorable variance. Anytime you see the word favorable, it usually means that my actual costs are less than my standard costs. It means I came in below budget, basically, right? And so that's a good thing. Every time I come in below budget or below the standard, that's a really good thing. That means I'm saving costs somewhere, right? And so that's favorable. Anytime I save costs somewhere, it's a favorable thing. Just as a reminder, if you could all mute yourselves when you're not talking, that'd be great.
Yeah.
Okay, thank you so much. Okay, so again, anytime you see the word favorable, that means my actual costs are less than my standard costs. So if I'm coming in below budget or coming in below the standard, that means it's favorable. I'm saving money somewhere. So anytime I save money, that makes me happy, and that's a favorable thing. It's unfavorable if the actual costs are higher than the standard cost. And something like that might happen if my cost of labor is higher than I expected it to be, or my cost of materials are higher than I expected it to be. And that will be an unfavorable cost variance. Everyone understands the concept of favorable and unfavorable? Yes. Yes? Wonderful. Thank you so much. Okay, so let's keep rocking and rolling. Okay, so this is just a graphic representation of the difference between favorable and unfavorable. Again, favorable, if the actual costs are less than the standard cost, then it's favorable. If it's unfavorable, that means my actual costs were higher than my standard cost. Okay, so let's look at it from a report perspective. The budget performance report summarizes actual costs, standard costs, and the differences between the two. As you know, the differences between actual cost and standard cost are called a variance. The word difference means variance. It's the difference between actual and standard. So all of these together are on our budget performance report. This report is based on the actual production rather than the planned production. Okay, so going back to our example, let's assume Levi wants to produce 5,000 pairs of jeans in the month of June. Now, to make the 5,000 pairs, my total direct materials will cost me $40,150. The direct labor will cost me $38,500. The factory overhead will cost me $22,400. Okay. To give me a total cost to manufacture 5,000 pairs of blue jeans will be $101,050. It's a lot of money. Okay, so let's break it down. Okay, so we're going to look at our standard cost, our actual cost, and the variance. Now remember, the standard cost is if my expectations, right? What I expected each line item to be. So my direct materials actually cost me $40,150. However, I was expecting that to come in at $37,500. Is that favorable or unfavorable? What do you think? Any thought?
Unfavorable.
That's correct. It's unfavorable. And the reason being is because my estimation, my actual is higher than my estimation or my standard cost. So again, anytime you see actual cost being higher than the standard cost, it's unfavorable. So in this case, it's unfavorable by $2,650. That means I probably had too much waste in material, or maybe I purchased more material than I had expected to use, or the cost of material was higher than I expected it to be, which is probably the case. And so now looking at direct labor, my actual direct labor was $38,500. I expected my direct labor to come in at $36,000. That, of course, gave me an unfavorable difference or unfavorable variance of $2,500. And the reason why it's unfavorable, again, is because my actual costs are higher than my standard cost. This probably means that the hourly rate of the employees were higher than I expected it to be. Now, looking at factory overhead, my actual factory overhead cost was $22,400. I had budgeted for $24,000. That means I have a favorable variance of $1,600. What probably happened here was I used less machine hours on my sewing machines than I had anticipated. So which means my employees were probably very efficient, and they saved me $1,600. And so you see that what we do after that, after we get our direct materials, direct labor, and factory overhead for our actual, our standard, and our difference, our cost variance, we add all of those up. So my actual cost was $101,050. My standard cost, which is what I expected it to come in at, was $97,500, which gives me a total unfavorable variance of $3,550 for the month for the 5,000 pairs of blue jeans that I had manufactured. Now let's take a look at how all that looks here in a little bit. Any questions so far? We're good? Great.
At this moment.
Wonderful. Thank you so much. Okay, so let's keep going. So looking at manufacturing cost variances. Now again, variance means the difference. So the total manufacturing cost variance is the difference between the standard cost and the actual cost for the units produced. So again, I made 5,000 pairs of blue jeans. We had noticed in the previous slide that I had a difference between my actual and my standard for the 5,000 pairs. And so what that tells, that is the total manufacturing cost variance. For the control purposes, each product cost variance is separated into two additional variances. The two variances that we're going to look at are direct materials and direct labor. So here's what we do. The total direct materials variance is separated out into price and quantity variances or differences. This is because the standard and actual direct materials costs are computed by the following. Our actual direct materials costs, we take our actual price that we purchased our materials at, and we multiply that by the actual quantity that we purchased. Makes sense, right? Our actual direct materials cost, we take our actual price that we purchased the materials at, and we multiply that by the actual quantity that we purchased. And we compare that to our standard cost. To calculate our standard direct materials cost, we take our standard price that we expected to buy the materials at, and we multiply that by the standard quantity, the amount that I expected to purchase. And then what we do is we get the variance for each. Okay, so the direct materials cost variance, we take our price difference and we add that to our quantity difference. To get our price difference, we are simply taking our actual price and subtracting that from our standard price. To get our quantity difference, we take our actual quantity and we subtract out our standard quantity. Does that make sense?
Professor, can you say that again? I got lost a little bit.
Sure, I'll break it down again. Okay, so to get our actual direct materials cost, we take our actual price that we purchased our materials at from our vendor. That in this case our blue jeans, our raw materials to make the blue jeans, what we actually purchased it at per square yard. We multiply that by the actual quantity of materials I purchased from our vendor to make our blue jeans. That gives, when I multiply those two together, I get my actual direct materials cost. Price times quantity equals our direct materials cost. And then I compare that to my standard direct materials cost, what I expected the price per square yard to be for the blue jeans material. That's my standard price. I expected to pay a certain amount of dollars. I think it was $5 per square yard. That's what I expected to pay. But I actually paid $5.50 per square yard. The amount of materials I wanted to purchase, I believe, was somewhere around, I forget what it was. But I expected to purchase a certain quantity of blue jean material to make the blue jeans, right? And so I take my standard price, which was my $5 per square yard. I multiply that by the amount of materials I expected to purchase. And of course, I want to look at the difference between my actual price and my standard price. And I also want to look at the difference between my actual quantity and my standard quantity. In order to do that, I would subtract out my actual price from my standard price to get the difference in price, or the price difference. And I do the same thing for my quantity. I take my actual quantity that I had purchased, subtract that from the standard quantity I expected to purchase to get my quantity difference. Does that make sense?
Yes, sir. Thank you so much.
Wonderful. Absolutely. My pleasure. Okay. So the actual and the standard material costs, they might be different because there was a price difference, meaning the amount that I expected to purchase my materials and the actual amount or the actual price that I paid to purchase. That would make up a price difference. And the quantity difference might be the actual amount that I had decided to purchase versus what I had planned, or both. These would cause differences. Oh, my favorite song. I'm just playing. Okay, so that's from that slide. We went over materials. Now we have to do the same thing for labor. We have to look at the differences for labor. So the total direct labor variance is separated into the rate of pay and the time. Okay, so going back to our example, our seamstress, we expected to pay our seamstress $9 per hour, and the actual amount of time it took, or that we expected it to take, was 0.8 hours per pair of blue jeans. That would be our standard direct labor cost. So looking at our standard direct labor cost, we expected to pay our seamstress $9 per hour, and we expected each pair of blue jeans to take 0.8 hours. So that would be our standard. Our actual direct labor cost, we probably came in somewhere around $10 per hour for our labor rate, and it actually took a little bit longer of time instead of the 0.8. And of course, that would give us some differences, right? So in order to figure out our direct labor cost variance, we're going to take our rate difference plus our time difference. And so to get our rate difference, we take the actual rate, which we're saying was $10 per hour or $9.50 per hour, something like that. And we expected it to be $9 per hour. So that would give me a rate difference of about 50 cents per hour or $1 per hour. And then the actual time minus our standard time that it took at the 0.8 would give us a difference, a time difference. And we add those two together to get our direct labor cost variance. Does that make sense?
Yeah.
Clear? Okay, great, wonderful. Okay, and the reason for the differences might be because there is a difference in the labor rate per hour, or there might be a difference in the amount of time it actually takes to make the blue jeans, or both. These would cause differences or variance. Okay, and then for factory overhead, so we covered direct materials, we covered direct labor. Now let's talk a little bit about factory overhead. The total factory overhead variance is separated out into what we call controllable variance and volume variance. We remember from budgeting from chapter 21, we talked about controllable budgeting, right? Our controllable expenses. These would be things that the managers have control over in their respective departments. And then we also talked a little bit about differences in volume, the amount that I'm making on a monthly basis. These, of course, attribute to my factory overhead. Because the factory overhead has fixed and variable costs, just like we learned about in chapters 20 and 21, we use different rates for the direct materials and direct labor, which are variable costs. And so, as you would expect, we separate those out. So let's look at it graphically. So this is just kind of putting everything together. So here's our total, right? So we break out our total into direct materials, direct labor, and factory overhead. The difference for direct materials would be direct materials price times the direct materials quantity. For labor, it would be the direct labor rate times the direct time. And the factory overhead rate would be the variable factory overhead controllable times the factory overhead volume, which would give me the total factory overhead cost. We take all three of these together to give us our total manufacturing cost variance. That's just a graphical representation of everything we just covered in the past few slides. Okay, now let's dive a little bit deeper. as we talked about, the total direct materials and the direct labor variances are separated into direct materials cost and direct labor cost for analysis and control purposes. Again, we have to keep revisiting our standards, right? And so in order to do that, we want to analyze that from the perspective of direct materials and direct labors as it changes over time. So here's how it looks graphically. We have our total direct materials cost variance, which includes our direct materials price variance and our direct materials quantity variance. We also have our total direct labor cost variance, which includes our direct labor rate variance and our direct labor time variance. This is what we talked about before. Now let's go back to our example and see how it looks. Okay, so during the month of June, our company, Levi, reported an unfavorable total direct materials cost variance of $2,650 for the production of 5,000 extra large blue jeans. This variance was based on the following actual and standard costs. Now remember, actual costs were the actual costs that I had incurred through the process for the month. My standard is what I had expected it to be. Now remember, the standard is what I expect things to be. You know, those are my estimates or my budgeted amount. And my actual is what actually happened, how much I actually spent in terms of price and how many I actually used in terms of quantity. So let's break it down. My actual cost for direct materials was $40,150. How did we get there? Well, I remember I had estimated I was going to spend $5 per square yard of materials, of blue jean material, right? I actually spent $5.50 per square yard. That gives me an unfavorable variance of 50 cents per square yard. So $5.50 is what I actually spent per square yard of blue jean material. I actually purchased 7,300 square yards of material, which is a favorable variance because I had budgeted to purchase 7,500 square yards, which gives me a favorable difference of 200 square yards. So I take my actual price of $5.50 that I paid per square yard, and I multiply that by the 7,300 square yards that I actually purchased to get me $40,150 of actual direct materials cost. And I compare that to my standard. My standard, I expected to spend $5 per square yard. I expected to buy 7,500 square yards, which would have given me a standard cost of $37,500. Now, what I do is I take my actual and I subtract out my standard to get me my cost variance. So my actual cost was $40,150. I subtract out my standard cost, which I expected it to be, was $37,500, to give me an unfavorable cost variance of $2,650. Does everyone see how we got there? Everyone sees how we got there? Yes, hopefully.
Yes.
Great. Okay, thank you so much. Appreciate the validation. Okay, so that's direct materials. Now, of course, we're going to look at direct materials price variance, and then we'll also pop in the labor in a few slides. Okay, so now let's talk about the direct materials price variance. We compute it by taking our actual price minus our standard price, and we multiply that by our actual quantity to get us our direct materials price variance. Now remember, we talked about the order of operations in mathematics. You guys remember this from a long time ago. So anytime that you see these parentheses, that means do this first, right? So what I would do first is I'll take my actual price, subtract out my standard price, and I'll take that amount and then multiply my actual quantity. And that together will give me my direct materials price variance. Now, just as you would think, if the actual price per unit is higher than the standard price per unit, the variance is going to be unfavorable. If the actual price per unit is less than the standard price per unit, then of course it's favorable. And that means I saved a little bit of money. Good stuff. Okay, so now let's put this into our example. Now, going back to our example, remember I spent $5.50 was my actual price per square yard of material. My standard price I expected it to be was $5. So that means I was over by 50 cents. That gave me an unfavorable price of 50 cents. I multiply my 50 cents times my actual quantity that I had purchased, which was 7,300 yards. That gives me an unfavorable variance of $3,650 for direct materials. Everyone sees that?
So, Professor,
Yes.
when you are doing the actual price minus the standard price, so that's how you get your 50 cents?
That's correct. Yep.
Okay.
So because I actually spent 50 cents more than I had expected to spend on each square yard of fabric. And so because I spent 50 cents too much on each square yard of fabric, that makes it unfavorable.
Okay.
Yep. And so I multiply that by my 50 cents times my 7,300 square yards that I actually purchased to get me my $3,650 of unfavorable variance for direct materials. Make sense?
Yes.
Great. Wonderful.
Yes.
Very, very good. Okay. So let's keep going. Okay, so now let's talk about the quantity difference. We talked about price difference. Now let's talk about quantity difference. So direct materials quantity variance is computed by taking your actual quantity that you purchased minus your standard quantity that you expected to purchase, and you multiply that by the standard price that you expected to pay. Okay. So again, you want to make sure you do your parentheses first. Your actual quantity minus your standard quantity, multiply that by your standard price. This gives us the direct materials quantity variance. Now again, just as you would expect, it would be if the actual quantity is higher than the standard quantity, that's unfavorable. That means I purchased too much materials, and that's just not good. That means I wasted some money, right? If my actual quantity that I produced is less than the standard quantity, that's good. That means I'm saving some money. That means I'm being efficient with my materials. So let's look at that in our example. So in our example, we actually purchased 7,300 square yards of material. I expected to purchase 7,500 square yards. And I expected to pay $5 per square yard. So what I do is I take my 7,300, I subtract out my 7,500, which gives me a favorable variance of 200 square yards. That means I actually used 200 less square yards than I had anticipated. So I take my 7,300 minus my 7,500, which gives me minus 200. And I multiply minus 200 times $5 per square yard that I expected to pay to give me a minus $1,000 favorable variance. That means I ended up saving about $1,000 from what I actually used. Does that make sense?
Yes.
Wonderful. Oh man, we're doing well. I'm so happy. This is working out good so far. Okay. don't get too crazy looking at this graph. This is insane, okay? There's too much detail on this slide, in my opinion. I didn't make this slide, the textbook did. But let me tell you, I'm not too happy with the textbook on this slide because it's just too much information going on at the same time. But I want to point out the more important detail of this slide. This is the direct materials cost variance down here at the bottom. We can see that our actual cost that we spent, now remember, we purchased 7,300 square feet of material at $5.50. Our actual cost from the materials was $40,150. We expected that to be $37,500 because we expected to purchase 7,500 square feet of material at $5. So what that did is it gives me the total direct materials cost variance of $2,650. I took my actual cost and subtracted what my standard cost was, or what I expected it to be, to get me $2,650. Everyone sees how we got there?
Yes.
Wonderful, wonderful.
Yes.
Okay, great. Thank you so much. That's it. That's the important part I wanted to show you from this slide. I really don't want to get into this other ridiculous stuff because it just gets a little too muddy, in my opinion, from a graphical representation. You already know how to do this stuff. We covered this in the earlier slides, but I just want you to be aware of the more important part, which is the total direct materials cost variance. Now, how is it reported? The direct materials quantity variance should be reported to the managers responsible for the variance. So we, as the accountant, we go back to our departments and we say, hey, you know, you guys in the purchasing department, you bought too much, or you paid too much per square yard of material. You know, you guys got to be careful spending 50 cents more than what we had planned, because it caused a variance, right? And so that's how it works. Like on the report, we would go to the respective managers and, you know, be like, hey, you know, you spent too much on raw materials. This isn't good. You know, you got to get your costs in line, right? And so, for example, an unfavorable quantity variance might be caused by either the equipment's not running properly enough, you know, so we would have to tell the managers, hey, you know, you guys wasted too much stuff of the material. What's going on? That may have been caused because the equipment's not running properly and maybe it needs to be maintained, or maybe, you know, there was a low quality of direct materials. Like maybe there was something wrong with the raw materials for the jeans, like the fabric. There was something wrong with it, and so in that case, the purchasing department should have been held responsible for that difference. So I'm going to skip this example. It's not the best example, honestly. So I'm going to skip this one because I really want to stick with our fun one, right? The blue jeans. Okay, so during the month of June, our Levi company reported an unfavorable total direct labor variance of $2,500 for the production of 5,000 extra large blue jeans. The variance was based on the following information. We actually spent $38,500 in labor. We expected to spend $36,000 in direct labor. So how do we get to the $38,500? What we did is we take our actual hourly rate. In this case, we ended up paying our seamstress $10 per hour. The actual amount of time it took them to make the 5,000 pairs of blue jeans was 3,850 hours. That gave us an actual direct labor cost of $38,500. Now, of course, we need to compare that to what we expected. We expected to only pay our employees $9 per hour, and we expected them to take 4,000 hours to manufacture the 5,000 pairs of extra large blue jeans.
Professor?
Yes.
Jazz wants to know, do we pay them less?
No, we actually paid them more. So we ended up paying them $10 per hour instead of $9 per hour. We planned to only pay them the $9 per hour, but we ended up paying them $10 per hour. And there might be a difference because, maybe they worked overtime, or maybe we got a higher quality employees that have more experience. And so therefore we ended up paying them more. Yep. And so, but you see, like in my mind, it looks like that person that we paid $10 an hour instead of that person that we paid we were planning on paying them $9 per hour. The one that we paid $10 per hour, it looks like they were more efficient. And the way you can tell that is by looking at the actual time. We had planned on 4,000 hours, but they only took 3,850 hours, which tells me that the person I paid at $10 per hour was more efficient. And so of course that also meant that I paid more in terms of direct labor. So to get our variance or a difference, we take our actual amount that we paid to that employee to make the 5,000 pairs of blue jeans of 38,500 during that time. We subtract out what we expected it to be, the 36,000, to get our direct labor cost variance of $2,050, $2,500. Does that make sense? Questions?
Yes.
Great.
Yes, sir.
Wonderful, wonderful, wonderful. Okay, so that's labor. We talked about materials. Now we talked about labor. Let's talk about the labor rate variance. So very similar to our direct materials rate variance, we have to calculate the direct labor rate variance. And so to do that, again, order of operations, we take our actual rate per hour, which was $10 per hour in this case, minus the standard rate per hour, which was, we were planning on paying them $9 per hour. So that gives us a difference of $1 per hour. And we multiply that by the actual hours taken. Going back to our example, the actual hours were 3,850. So you would take your $1 difference, right? Your actual rate per hour of $10 minus the standard rate per hour, $9. That difference is $1. We multiply that by the 3,850 hours taken to make the 5,000 pairs of blue jeans to get us to $3,850. And I'll show you that in the next slide as well. If the actual rate, again, if it exceeds the standard rate, it's unfavorable. So in this case, it's unfavorable by $1 per hour. If the actual rate would have been less than the standard rate, then it would have been favorable. But of course, in our example, it's not. So let's see how it looks. Again, we take our actual rate per hour, which was $10 per hour. That's what we actually paid the employee. Minus the standard rate per hour, what we expected to pay them was $9. So we're over by $1. We multiply that by the actual hours it took for the employee to do the blue jean, the 5,000 pairs of blue jeans. That was 3,850 hours of work. That gives us an unfavorable variance of 3,850. We got there by taking our $1 and multiplying that by 3,850. Everyone sees how we got there?
Yes.
Great. Awesome. Wonderful. Thank you. Okay. So we looked at that difference from a perspective of the rate per hour. Now let's look at it in the difference of time, how long it took to make the blue jeans. Okay, so the direct labor time variance is computed by taking your actual direct labor hours and you subtract that by the standard direct labor hours. In this case, it's favorable because remember, the actual direct labor hours was 3,850 hours. We expected that to take 4,000 hours total. So we would take our 3,850 hours minus our 4,000 hours and multiply that by the standard rate per hour, which was $9. So I think it's, and I'll show you what that looks like in the next slide, but I just kind of wanted to help you understand this, how this formula works. If the, and very similar to before, if the actual is greater than the standard, then it's unfavorable. If the actual is less than the standard, then it's favorable. In this example, it's favorable because the total amount of hours used to create the 5,000 pairs of blue jeans was 3,850 hours. We expected it to take 4,000 hours, and we expected to pay our employee $9 per hour. So we would take the difference between 3,850 minus 400, multiply that by $9 to get us a favorable variance of minus $1,350. That means I ended up saving $1,350 from the perspective of the amount of hours it took to make the 5,000 pairs of blue jeans. Does that make sense? Yes. Great. It follow, you notice a pattern, right? And it really is the same concept we're applying. We're just applying it to different areas within the process, right? So very similar to the slide I showed you earlier, we have a direct labor cost variance. We get that by taking our actual cost minus our standard cost to get us to a direct labor cost variance of $2,500. I don't want to spend too much time on that slide because it's a little confusing. Looking at it from a graphical representation. Okay, so let's look at how the report looks. Production supervisors normally are responsible for controlling the direct labor cost. So just like if you were a store department manager, you're responsible for managing your employees within that respective department. So a report would be generated and it would tell you if you're paying your employees too much or they're using too many hours. That would make it unfavorable, right? And of course, the opposite is true. Like if you're paying your employees just right and they're working less hours, then that would be favorable, right? So these types of reports are really helpful for us as managers to understand how effective our employees are and also how much we're paying them. Oftentimes, you'll see sometimes for skilled labor, just like we saw in our earlier example, the $9 an hour employee would have spent 4,000 hours making the blue jeans. I paid a $10 an hour employee, paid them a little bit more, and they took less time to make the jeans. So in that case, I mean, you kind of have, as a manager, you kind of have to look at this. It's like, okay, well, I'm a little bit over, sure, but at the same time, that more skilled employee saved the company in terms of hours. So you just, as a manager, you kind of have to make these types of calls. So that's kind of what this slide is telling us. Here's another example. Not going to go through it. So I like our other example a lot better. Okay, now we covered materials, we covered labor. Now, of course, we have to cover overhead, right? So factory overhead costs are analyzed differently than direct labor and direct material costs are because, as you know, overhead costs have both fixed and variable elements to them. And we, of course, learned this in earlier chapters. Okay. Factory overhead costs are budgeted and controlled by separating factory overhead into fixed and variable components. So what we do is we allow the preparation of flexible budgets that you learned about in Chapter 21 and the analysis of factory overhead controllable and volume variances. And so let's talk a little bit more about how that looks. This is just a graphical representation using Excel of how something like that would look from an operating capacity. We talked a little bit about this when we talked about in budgeting back in chapter 21. You might remember this. I know it was a couple weeks ago, but we talked about the concept of capacity. You know, if the company's at 80%, 90%, 100%, 110% capacity, we can see, of course, the differences in units being produced, direct labor hours being used, and then, of course, our budgets separated out in variable costs and in fixed costs. Let's use a slide that kind of represents in the terms of comparison. So don't focus too much on this slide, but I just kind of wanted to show you what it looks like from a capacity perspective when we're doing budgeting, right? So let's look at it from a formula of the factory overhead rate. The budgeted factory overhead rate for our company, our Levi, is computed by taking the budgeted factory overhead at normal capacity. We divide it by the normal productive capacity. So going back to our slide, so it looks like we got 30,000. So 100% would be what we consider normal, right? That's what we expect it to be. We always, when we do our budgets, we budget it at 100% capacity. So our factory overhead costs in this example are 30,000. And the amount of hours taken is 5,000. That's what we had planned for at 100% capacity. So 30,000 divided by 5,000 is $6. So let's look at that a little bit closer. So we took our budgeted factory overhead at normal capacity at 100% is 30,000. That's our budgeted factory overhead at 100%, $30,000. We divide by the normal productive capacity, meaning we expect to use 5,000 direct labor hours at 100%. We take our $30,000 factory overhead at normal capacity, divided by the 5,000 hours that we expect to use at 100% to get $6 per direct labor hour. This amount is our factory overhead rate. Does everyone understand this?
Yes.
Yes? Oh, great. Wonderful. Okay, let's move forward. Okay. So here we go. For analysis purpose, just like we did in chapter 21, when we're looking at factory overhead, we have to break out our variable and our fixed rates, right? We have to separate the two for analysis purposes. And so what we do is we are going to subdivide the two. And so in our example, the variable overhead rate and fixed overhead rate are computed by the following. Our budgeted variable overhead rate at 100% is $18,000. If we go back to this, our variable cost at 100% is $18,000. Okay. And remember, variable costs include things like indirect factory wages. Those are your supervisors, the power for the building, and indirect materials like small parts that we use that are not a part of the whole manufacturing process. Those are indirect. Those are variable. Yeah. So our variable cost is $18,000 at 100% capacity, and our fixed costs at 100% capacity are $12,000. Our fixed costs include things like supervisor salaries, depreciation of property, plant, and equipment, and insurance. Those are things that do not change over the course of 12 months. Therefore, they're fixed, and we have to calculate that as $12,000. That $12,000 is the fixed costs that make up the factory overhead fixed costs. So let's look at that. Going back to our separation. So $18,000 is our variable factory overhead at 100%. We divide that by the 5,000 hours of labor, normal productive capacity at 100%. That gives us $3.60 of direct labor that is attributed to variable factory overhead. So our variable factory overhead rate is $3.60. We apply the same process to fixed factory overhead rate. That is our budgeted fixed overhead at normal capacity, 100% is $12,000. Our normal productive capacity, that's the number of labor hours I can utilize at 100%, is 5,000 hours of direct labor. 12,000 divided by 5,000 is $2.40 per direct labor hour. Make sense? Now notice if you add together the variable factory overhead rate plus the fixed factory overhead rate, if I add this $3.60 plus the $2.40 of fixed, that equals $6. So again, I add my variable fixed factory overhead rate plus my fixed factory overhead rate together to get to a total factory overhead rate of $6. Make sense? Yes. Yeah. Great, wonderful. Okay, so moving on. Variable factory overhead and controllable variance. Oh my, this part gets exciting. So take a nice deep breath. Remain calm. It'll be all right. We'll get through these next 4 slides, I promise. Nice sip of coffee there. Okay, ready. The variable factory overhead controllable variance, again, controllable means the amount that the manager can actually control, is a difference between the actual variable overhead costs and the budgeted variable overhead for actual production. The variable factory overhead controllable variance is computed by taking your actual variable factory overhead and we subtract out our budgeted variable factory overhead. And as you would expect, if the actual is less than the variable, it's favorable. If the actual is higher than or greater than the budgeted variable, then it's unfavorable. Okay, so now let's look at the budgeted variable factory overhead. This is the standard variable overhead for the actual units produced. We compute it by taking the standard hours for the actual units produced. We multiply that by the variable factory overhead rate. So going into our example, when we produced the 5,000 pairs of extra large blue jeans, the standard hours that we had planned for was 4,000 hours. And our variable factory overhead rate, we said, was $3.60. We multiply those two together to get $14,400. The $14,400 is our budgeted variable factory overhead. Now, let's assume that the company, Levi, incurred the following actual factory overhead costs. We actually incurred variable factory overhead costs of $10,400. Our fixed factory overhead costs that we actually incurred was $12,000 to give us a total actual factory overhead of $22,400. I got that by adding my fixed and variable together overhead to get the total factory overhead. Based on the actual factory overhead costs incurred in the month of June, as we see above, the variable factory overhead controllable variance is $4,000 of favorable variance. How did we get that? We took our actual variable factory overhead of $10,400 We subtracted out the budgeted variable factory overhead of 14,400. That's, again, the budget is what I expected. The actual is what I actually did for the month. So I take my actual minus my budgeted to get a favorable variance of minus $4,000. Everyone sees how we got there? Yeah, good so far?
Yes.
Wonderful. Thank you so much. The variable factory overhead controllable variance indicates the company's ability to keep the factory overhead costs in line with the budgets. Because variable factory overhead costs are normally controllable at the department level, responsibility for controlling this variance usually rests with the department supervisors. So again, those department supervisors are ultimately responsible for any differences. We're going to skip this example. Okay, so now let's look at the fixed factory overhead volume variance. Fixed factory overhead volume variance is the difference between the budgeted fixed overhead at 100% capacity and the standard fixed overhead at the actual units produced. So to calculate the fixed factory overhead volume variance, we take our standard hours for normal capacity. In this case, I think it was 4,000, I believe. So we subtract out the standard hours for actual units produced. I think it was like 3,380, something like that, times the fixed factory overhead rate, which I think we said was it was like 2 something. I forget. Well, I'm sure we'll find out real shortly. That's how you calculate the fixed factory overhead volume variance. And as always, if the volume variance measures the use of fixed overhead resources, so that's your property, plant, and equipment. The interpretation for unfavorable and favorable is the following. Again, it's unfavorable if the fixed factory overhead is greater than the actual, and it's favorable if the fixed factory overhead is less than the actual, if the actual is less than what was planned. So let's look at it from our example. The standard hours at 100% capacity is 5,000 hours of labor. The standard hours was 4,000 hours. So 5,000 minus 4,000 is 1,000. Our fixed factory overhead rate, we said it was $2.40. So 1,000 times $2.40 is $2,400, which is unfavorable variance. That means that my labor at 100% is greater than the actual, which is unfavorable. Questions? Are we good? Great. Okay. Now let's talk a little bit about this fancy thing we call break even. We're going to get into break even. You probably remember break even from, if you've had economics already, you would recall the term we call break even. It's where our fixed costs, it's where our costs equal the amount of revenue that we're generating. I'll show you what that looks like. So this is just a graphical representation of fixed overhead volume variance. I want to show you break even here in a little bit. Its unfavorable volume variance is caused by things like failure to maintain even workflows, machine breakdown, work stoppages, by lack of materials or skilled workers, or a lack of enough sales orders to keep the factory operating at its 100% capacity. We'll skip that example. Okay, now let's go back to our earlier example, our jeans, right? Our Levi. The total factory overhead cost variance can also be determined by the sum of the variable and the fixed overhead variances. We said that our variable factory overhead controllable variance was a minus 4,000, which is favorable. We add that to our fixed factory overhead volume variance. We said it was unfavorable, 2,400. We add these two together to get a minus $1,600 of favorable variance. So that means I am being very efficient at managing my variable and fixed expenses. A factory overhead cost volume report shows management of how to control our factory overhead costs, budgeted and actual cost variances, and fixed factory overhead, along with the related controllable and volume variances, are reported by each cost element. So here's how a report like that would look. So that going back to our example, we see here 100% capacity, we're looking at 5,000 hours. The actual production for the month, we came in at 4,000. So that could be problematic. Our actual came in below what we had planned. Looking at the budget comparison to the actual, we can see that our variable factory overhead was less than our budgeted amount. We can also see that our fixed factory overhead costs came in less than what we had budgeted. And we can see that this is favorable 1,600. This just kind of shows, goes back to what we see on this slide here. This just is a way of looking at all the detail and that in terms of a variance report. So let's break it down a little bit further. The applied factory overhead for Levi was to make the 5,000 jeans in the month of June. We took our 5,000 jeans, which is our actual production, we multiplied that by 80 cents per labor hour to make each pair of jeans. So it took 0.8 amount of time. So 5,000 jeans, each jean took 0.8 hours to make, times the rate of $6. Gets us a 24,000 of applied factory overhead. The first thing you would do, of course, order of operations, you take your 5,000 jeans, you multiply that by the 0.8 hours it takes to make each pair of jeans to get us to 4,000 direct labor hours. Multiply that by the $6 overhead rate to get to 24,000 of applied factory overhead. The total actual factory overhead for Levi is 22,400. Thus, the total factory overhead cost variance for Levi for the month of June is minus 1,600 of favorable variance. We took our actual factory overhead of 22,400. We subtract out our applied factory overhead of 24,000 to get us a favorable variance of minus 1,600. Everyone sees how we got there?
Yes.
Yes. Great. Wonderful. Okay. At the end of the period, factory overhead account normally has a balance. It normally carries a debit balance, which represents underapplied overhead. If it carries a credit balance, it represents overapplied overhead. And this is very similar to chapter 19, I think it was, when we talked about over and under application of overhead. It's the same concept. Okay. Well, this is pretty much the same, just okay. Underapplied and overapplied factory overhead account balances represent the following. Underapplied factory overhead is unfavorable, and overapplied factory overhead is favorable. And then here's how it looks from a T account perspective. You guys remember those T accounts from Accounting 201? Let's see. Variable factory overhead controllable variance and the volume variance can be computed by comparing the factory overhead account with the budgeted amount, as you would anticipate, to figure out if it's favorable or unfavorable. Here's how it looks from a graphical representation, just very similar to the previous ways that we've broken this out. Okay, we're almost there, I promise. We're almost done. Okay, so we take our standard recording and reporting the variances. In reporting, we take their standard costs that may be used by management to control costs separately from the accounts and the general ledger. However, most companies include the standard costs in their accounts. One method of doing so is by recording sustained costs and variances at the same time that the actual product costs are recorded. So in other words, I would record my standard and actual every single month as they occur. So that way I'm constantly comparing my actual to my standard. Helps me as a manager to keep my costs in line. So going back to our earlier example, we had purchased 7,300 square feet of material at $5.50 per square yard. The standard price, as you recall, was what I wanted to spend was $5 per square yard. So the journal entry would look like this. The materials was 7,300 square yards at $5 per square yard. It was $36,500. The direct materials price variance is $3,650. How I got there is because I actually purchased 7,300 square yards at $5.50. That was $4,150. To figure out what your variance is, you would take your actual $40,150 minus your standard, which is $36,500, to get you the direct materials variance of $3,650. So this is what it would look like in a journal entry format. And we can do the same for everything else, right? So talking about our earlier examples, we had talked about the process for transferring materials. We talked about that, I believe, in chapter 20. We talked about work in process. We talked about raw materials, work in process, finished goods, right? Those are our three primary categories for inventory. And so the same can be said as we transfer products and direct materials. So the company used the 7,300 square yards to create the 5,000 pairs of blue jeans. The standard quantity of the 5,000 pairs of blue jeans produced was 7,500 square yards. And so the standard price of the materials was $5. So we would do the same process. We would take the work in process was 7,500 square yards at $5. We only actually use 7,300 square yards at $5. So the difference would be a credit balance, meaning favorable, of 1,000, which is the difference between the 37,500 and the 36,500. As you know, with debits and credits, they must always equal. So that's why you see our debits of 37,500 equals these two credits together. I'm not going to go through that example. Okay. And the same concept applies for work in process, wages payable, direct labor rate, direct time variance. So those journal entries will look very, very similar in that regard. That's all that slide is telling us. Factory overhead account already incorporates the standard costs and variance costs into journal entries, as we talked about. I'm not going to go through all that. It's too much. At the end of every period, the balances for each of the variance accounts indicate the net favorable or unfavorable variances for that period. These variances may be reported on an income statement prepared for management's use. This would be an example of our blue jean company income statement. Just kind of shows you what that would look like if you're comparing favorable and unfavorable, we can see which are our variances in each category, right? Variances are not reported to external users. Again, these reports are really for our managers to make decisions. It helps us also to prepare our cost of goods sold as it would be normally transferred in and out of the various stages. We have our raw materials, work in process, finished goods, as you know. And you learned about those processing transfers back in chapter 20 and 21. And so that I think we're almost there. Okay, almost there. Now let's talk about non-financial. With every company, we have both financial goals and non-financial goals, and these measure our performance. A non-financial performance measures the expressed performance in a measure other than dollars. So, like for example, a lot of our HR people in the room, we evaluate our employees based off of performance reviews. In a manufacturing setting, I would measure my employees' performance based on the amount of time that they take to manufacture each pair of blue jeans, the quality of each produced product, and the amount of quantity that employee is producing in a given amount of time. And so those measures I would use to evaluate the performance of an employee. You could actually evaluate the performance of the whole company based on these measures as well. Other non-financial performance measures include things like inventory turnover. That means how quickly am I selling my inventory? The percent on-time delivery. How quickly am I getting my jeans to my customers? The elapsed time between a customer's order and the product delivery. How long did it take for me to get the jeans to my customers? Customer performance rankings compared to my competitors. So Levi in comparison to Western Wear, in comparison to other jean companies that are out there. Where do we stand in terms of customer preference ranking? Do customers prefer Levi over Western Wear? Do customers prefer Western Wear over Levi, so forth and so on, right? Response time to a service call. How quickly can I get a repair done on a customer's pair of jeans? The time to develop new products. So if I want to come out with a different style of pair of jeans, how long does that R&D process take? Employee satisfaction. Are my employees satisfied working at Levi? The number of customer complaints. Are the customers complaining about our service, our product? What type of complaints are those? How many complaints are there? These are all non-financial performance measures to help evaluate the performance of our company. So in looking at that, the non-financial measures are often linked to either the inputs and outputs of activity process. Inputs being the employees in the process, outputs being the jeans themselves as they're being sold to customers. A process, as you know, is a sequence of activities for performing a particular task, like making a pair of blue jeans. So again, our inputs would be the labor, materials, overhead. Those are our inputs. The activity process is the process of manufacturing the blue jeans. The outputs are the finished goods, the blue jeans being delivered to our customers. From further non-financial, this is an example from like a restaurant. Inputs would be the employees, the amount of employee experience, employee training, reliability of our equipment. What type of things are being offered on our menu. Activity would be the actual service and production of our product. The output would be how long customers are waiting for the product. The accuracy of the product, and the service from our employees. Just keep going through these wonderful examples. And we are done with chapter 22. Yay!
Woohoo!
We made it! Yeah!
You.
Yeah! Great. So wonderful. And look at that. We're well ahead of schedule. Yay. That means you get to enjoy the rest of your Saturday. That's fantastic. Okay.
Who's
So,
going outside?
well, you know, you can at least get some fresh air. Just open some windows or, you know, just take a step outside and enjoy the
Corona is
weather.
outside. Corona is outside, so you should not open your window.
Well, I guess I'm in trouble then.
Make sure you
Be in your house.
I heard,
It's gonna be
I
in
heard
your
you
house.
live in the heat.
Okay, Professor, I have a question.
Yes, please, Mary.
How you doing?
Good. How are you, Mary?
I'm doing fine.
Great.
You know, some of us come like late in the class. So
Yeah,
I think you have like announcement. Can you repeat that, please?
Yeah, sure. So I do want to let you know that the video is being recorded. So you'll be able to go back and watch the parts that you missed, which is fantastic, right?
Okay.
I do want to cover the what I had said earlier. You know, now because we're meeting online, and I don't want to penalize anyone for missing these sessions. So instead of providing you participation points for attending the sessions, the new requirement is that now we have to participate in the discussion forums. So for chapter 22, it looks like somebody's already participated. The way it works is you when you're in your Blackboard classroom, select discussion board and come down to chapters 22 through 27, and you'll go in each week and go in and answer the discussion question. So in this case, the discussion question is describe a non-manufacturing business that could benefit from the standards. Also explain how standards would help the business to control its operations. So it's a very open-ended question. What you would want to do here is go into the discussion forum. It looks like Devon already made a nice response. So what you would do is you would go in and you would create a new thread. And you would say my response, or you could put your name or whatever, you know, whatever you want. Original response, Dr. B. And then you would say this is my response. I think that standards are beneficial for companies because ... And then you would develop a nice paragraph response for each question, and then you would click submit when you're ready. And then also what you want to do is just try to respond to two of your classmates. And the way you would do that is you would click on your respective classmate. You would read what your classmate had written, and then click reply. And you would say, hi, Devon. This is a great response. I think that companies would benefit because ... And create like a decent paragraph as well in response to two of your classmates, and then click submit. And so your participation in the discussion forums will take place of the participation in the classroom. Does that make sense?
Yes.
Wonderful. Great.
Okay.
So that means each discussion forum is worth 10 points.
Yeah.
Yay.
All right.
Yeah.
Okay.
So get to talking out there.
Professor, how do you get that picture?
The picture?
Okay.
Yeah, the picture.
Yeah. So if you go to the top right in the classroom, there is where it says global navigation menu. You can if you click the drop down, there should be I think it's like a settings. You might be, or it might be, how can I put this? If you click on where your picture is right now, you should be able to customize your portfolio. It's been so long since I've done it, to be honest. I think it's like Blackboard Home, maybe. Blackboard Tools? No, that's not it. I forget, to be honest.
Okay, just figure it out and then you can let us know.
Yeah, I figured it out. No worries. I'm figuring it out now.
I think if you're talking about adding your picture, because I added mine, and I think right where the arrow, the drop down arrow, it says settings or profile or something like that, if I'm not mistaken, or the circular one. But yeah, settings is down at the bottom there. Go back, Professor. You see go down, down, right there. It says settings.
Oh, I see it now. Yeah, settings. Okay, great.
Yeah.
Oh yeah. Oh, cool. Yeah. So if you click on the part global navigation menu, and then go down to settings at the bottom, and then from there you can change a lot of different things. Change your text size, contrast settings, personal information. So under personal information, yeah, from here you can select personalize my settings, and from there you can upload your picture.
Oh, okay.
Yeah.
I just don't have any pictures of me on my computer.
But you know, yes.
Yes, I wasn't going to. I was the one that sent the email about the funeral. Now, I was able to participate only because because of the coronavirus going around.
Sure,
They
sure.
cannot do mass gatherings. So I'm like, I prefer to stay away anyway. They only allow certain, like 50 people. I'm not trying to
Right.
get sick or catch no coronavirus from nobody. So.
Exactly.
Oh.
Janika, what was your question though? Did you have a question?
I had a question, but I forgot what I wanted to ask. But I'm
okay.
sorry.
Take your time. Take your time, Tanika.
Yeah, yeah. If you think about it, feel free to email me. I'm always around.
Email. Yes.
Great, awesome. Well, if there's no other,
Professor, can I address Kiva right quick? Kiva, if you have Blackboard on your PDA, your phone device, and you have pictures in your phone, you can do it that way as well.
Oh, okay, cool.
cool. That's
You
good
know,
to
my
know.
pictures in my phone.
Yeah, there you go. That's a great idea. Yeah, and I'll add to that. I'll say, when you're learning in an online environment, it's really nice to have like your picture, because it kind of like it puts a face to a name, right? And it kind of like makes it a little bit more personal than just us talking without cameras and stuff like that.
Yes, definitely. And that's a really cool picture. I think it's just your
Thank you.
What were you at a wedding?
It was my wedding.
Oh,
Wow, that's nice picture.
Nice.
Yeah, thank you. Okay, so if there's no comments, questions, or concerns on the content, I think we should call it. And what'll happen is it'll take a little bit of time for the recording to finalize, and then it'll be automatically emailed to all of you. In addition to that, I will post a copy of the recording onto my YouTube channel, and I'll also link it to the classroom. So that way you're more than welcome to go back and rewatch and stop and play and all that good stuff. So that way you make sure you didn't miss anything. Okay.
Okay, sounds good.
Wonderful. Okay, well this was a good first session, and it looks like we have probably the rest of the semester of this online. So just be patient, and it'll all work out, I promise.
Okay.
Okay.
Okay, stay safe, everyone.
Yes, thank you, everyone. Have a wonderful rest of your day, rest of your weekend. Stay safe. Wash your hands, and stay safe and wash your hands some more. And so thanks again, everyone. I appreciate y'all being here. And I'm going to go ahead and end the recording, and I'll also end this session. So thank you again, everyone.
guys.
Take care.
Have a good day, everyone.